Hey everybody, great show today. Ryan Harsche from My City Mortgage comes on and talks about some investor financing options. Ryan's a longtime investor himself out of the eastern Pennsylvania area, and he has a lot of good information coming. So thanks for joining, Ryan.
In the commercial world, it's all based on the house. How much is it worth now? How much money are you going to spend to fix it up? What's it worth after? And does that make sense? And if it does, pretty much anyone with a decent credit score and money in the bank to pay for the down payment and closing costs is going to qualify.
Welcome to the REI Partners Meetup. We're your hosts, Matt Morrow and Richard Clark. This is a place where knowledge is shared, friends collaborate, as we help each other to succeed in both our real estate and personal goals. We are a group of like-minded individuals from across the country who are here to help and support each other. Investors, realtors, entrepreneurs, and many others contribute to providing diverse and practical content for our events, especially our mentors who enjoy helping new and experienced investors in their journeys. Thanks for joining. We hope you enjoy the show and encourage you to bring others who may find value as we invest in our collective future. All right, guys, thanks everybody for joining. We have quite a diverse group today, expecting a few more calling in. We're going to start off with a little bit of some member learning stories. Unfortunately, the two gentlemen who are going to present this are deep in their landlord duties right now and not able to make the call. But two of our guys, TJ and Ryan, both bought their first investment properties this past month between December and January, and both of them hit some pretty interesting issues right off the bat. So just kind of a point of information for guys, if you're starting to invest in a area or in a property that is vacant when you buy it or newly renovated when you buy it without tenants in place, you can find yourself with some interesting issues. TJ, he closed on half a double in Bethlehem in the beginning of December, got it for a steal. He presented last month. So if you want to see the details on that deal, go back to the YouTube page and look through it. But he did have, after the tenants moved in, he had a few significant maintenance issues that were purely from the home not being neglected, but not being occupied. Plumbing problems going from a vacant house not being used for a few months to a family moving in, having some plumbing issues, and then some useful issues with some cabinetry, some appliances. So if you'd like more details on that, reach out to TJ. He got hit pretty good from the beginning with some new landlord gotchas. And then Ryan as well, he is in the process of renting his 2-unit in Allentown. Ryan Harsche on the call here is actually a lender for that one. He helped him out really well. Sweet deal in Center City, Allentown, 2-unit. He's going to own or occupy, so he's going to live for free. But the place was recently remodeled, and during the walkthrough, we found some small items. Then we found a pretty substantial plumbing leak in the basement after he closed. And thankfully, he doesn't have any tenants placed yet, but he was able to fix that, got some roof issues solved, and he's going to be opening an open house actually tomorrow and hopefully going to place some tenants here in the next few weeks. But vacant properties, you're going to be the first one to go in and actually find all the issues that come in. Hey, Greg, welcome to the meeting. We're just getting started here. We were just talking about some vacant property issues for new landlords, and this thing's going to get rolling here with Richard here. So you guys have any questions or things for Ryan or TJ? I know they're not on the call, but we can talk about it a little bit if you'd like. All right, cool. Richard, you want to take off with, we have this new section called the Terminology Toolbox, little cool thing. I'm going to go over just little investment terms on each meetup to make sure everybody's on the same page, and knowing that people are brand new to investing all the way through to experienced landlords. So Richard's going to take it away with his little terminology toolbox here.
Yeah, sure. We're going to, this is just a new format we're going to try and start to do, and hopefully, it'll be of some value to everyone when they're hearing certain terms and things like that out there, talking to lenders, what have you. Then it will be a little bit better for in terms of understanding. So Just real quick, terminally two, it's going to take 5 minutes. Going to talk about qualifying ratios, debt to income. I know Ryan knows all about this because he does it day in and day out. But so this is just something that he's familiar with. So feel free though, anytime to jump in if you have a comment that you want to make, some value add that you want to provide to the discussion is perfectly fine. But this is designed to only be a little 5-minute gig. We're going to talk about these two items, and we'll go from there. So qualifying ratios, when lenders first meet, with the borrower, for either pre-qualification or pre-approval, you make that phone call. You're looking to get pre-qualified before you go and look at or make an offer on the property. They're going to perform an analysis of what's currently liable. Now I'm talking about residential here. So, when it comes to commercial, that's a completely different thing. But for residential mortgages, this is what the lender typically will do. And he's going to look at what your allowable monthly housing expenses are. That's going to be your front end ratio. And he's going to look at what your debt to income is going to be. This is going to give him or her and the borrower, as a matter of fact, with a realistic understanding of what they can afford. So, two qualifying standards are in place. It's the housing expense ratio. This is basically your front end, how much house you can afford to pay for on a monthly basis, and then the total debt to income ratio or the debt service ratio on the back end. Besides these, they're going to put in the principal, interest, taxes, and insurance to see what they would what the overall numbers look like. And then they're going to say, okay, well, you can afford this much house or that much house. Just a little bit more in detail on the ratios. The front end ratio specifies the percentage of income that goes towards rent, mortgage payments, property taxes, hazard insurance, and mortgage insurance. The back end ratio specifies the percentage of income that goes towards all the recurring debt payments. That's all your debt. So including the ones that I just mentioned and additional payments such as credit cards, car loans, student loan, child support payments, things like that. Overall, the front end ratio helps measure the portion of income that goes towards housing costs, just the housing costs, while the back end ratio measures the portion of income that goes towards everything or all costs. Any questions on that? Did I nail that, Ryan? Is Ryan there?
You did pretty good there. I had to unmute myself, but yeah, I mean, I didn't. Did you go over the percentages that generally people look for?
That's what I got through next.
Okay.
Loan type
Well,
ratio.
I won't
go ahead,
steal your
Ryan.
thunder then.
I'm sorry. Say again.
I won't steal your thunder then.
No, man, you can steal my thunder anytime. Hey, this is the ratios that Ryan's just mentioned. We got in conventional financing, okay, you got what's called a 28% front end or housing expense ratio, and then you got a 36% DTI. The reason why I bold out the DTI is because that really takes into account, your situation. And that's going to be the number that people like Ryan and other mortgage lenders are going to look at more closely. And it's the one that really takes into account all the costs, like I just mentioned. The FHA is 31% on the housing expense and 43% DTI, which is nice. Now, you also have with the FHA a lower down payment potential, so 3.5%, whereas conventional, you're looking at 20% or more, all right, in order to avoid PMI. And then for VA, there is no housing expense. They only do DTI, which is 41%. So now I don't know about the US, and maybe Ryan, you have a comment on this, but the USDA or agricultural type packages or loan packages, what's the percentage on those?
Yeah, so a couple things. I don't know what the front end ratio on USDA. Generally, they want to see you stay below 43% on your back end ratio. A lot of these things are kind of very loan specific. So there's actually an automated underwriting system for every type of loan. So USDA has something called GUS, Freddie Mac has LP, Fannie Mae has DU, right? And FHA also uses DU. So these automated underwriting systems generally determine what they're willing to give each person individually. So while the ratios you said are correct, they're a little bit conservative. So conventional is generally going to be 38% on your front ratio is like the accepted number, but I've seen up to 41, 42, 43, 44%
Wow. Okay.
before it get accepted, right?
Yeah.
The back end ratio, if you're below 45, you're generally good, but some people they'll let go to 49% on the back end ratio for conventional. So really comes down to the actual person's strength, right? As far as their credit, and it takes into account everything, your credit profile, your income, how long you've been at your job, right? So there's a lot of things, how much you're putting down. So there's a lot of things that go into that. Where FHA is going to be more of like a 41, 42% front end max, and they will go to 54.9% generally on the back end debt to income ratio.
So
So that's about the max. I've actually
right.
had someone get
So
approved at 56% before, but that's not very often.
so the I think the learning moment from that comment, from those words, is that, you know what, these numbers are flexible. These are the numbers that I got from when I went through my real estate training and stuff. So that's where these numbers come from. But it's good to know that they are flexible, that, you know, each lender will have their own, or, you know, their own ways of determining the total overall DTI that they will accept.
Yeah, and they're generally nationally accepted, right? Because some lenders will have extra rules, but most lenders underwrite directly to what the government allows. So if that system gives you a green light, they're going to give it to you. So it's really up to that automated underwriting system, but it does take into account everything. So I've had people with 720 credit scores that I just couldn't get approved, period, just because something in their credit profile they weren't liking. And I've had people with 630 credit scores going FHA that, you know, had a debt to income ratio of 54 and they got approved. So it all depends on the type of loan and the profile as to whether it goes through or not.
Right. Good points. Thank you. That's excellent. So for a practical example, okay, the debt to income ratio is the relationship of the borrower's total monthly debt obligations and long-term debts, including principal, interest, taxes, insurance, to income. And here's the formula, guys. So debt to income ratio equals monthly debt payments divided by gross income times 100. Simple. Practical example is an individual pays $2,000 a month for their mortgage. They got $100 for car insurance, $500 in other debts. And if their gross monthly income is $4,500, their ratio is the add up all the debts divided by the gross income times 100, 57.78%. And Ryan could probably get this person approved.
Nah, they're off by 3%, but I'm sure we can find something to pay off to get them there.
Right. So that's pretty much it, guys. I just wanted to kind of, any questions on debt to income? Thanks, Ryan, for your contribution to this little blurb. It's just something that I want to get in the minds of people so that they know that when you use that term with them, they know what it means. You don't have to break out the color crayons. Any other questions? All right, good. That's it for that, Matt.
All right, Ryan, you just want to take it and go with your presentation? You want to do a little intro of yourself,
Sure, yeah.
and your background, and then get into it?
Yeah, so I'm Ryan Harsche. I am a mortgage loan officer and investor. So my day job is residential mortgages, and my side job is buying real estate and flipping or adding it to the portfolio and renting out a couple Airbnbs. So that's kind of where I'm at with that. I figured most people in here want to hear about a couple different things. So, you know, you have maybe the house hackers, right? Like like Ryan, who we recently closed, which would be the people that want to buy maybe a multifamily, live in a unit, rent out the other units, and then maybe, you know, buy something again a year from now. And then also the commercial side of things, which would be like the LLC purchasing and things like that. So, you know, on the standard, you know, residential types of loans, you know, they're going to be a little different. So if you're buying a house that you're actually going to live in, there's different rules than houses that you're buying just to invest, right? So if you're going to live in a house, you can go either FHA or conventional, FHA is going to allow 3.5% down on 1 to 4 units. All right. And conventional is going to allow 3% down minimum on a 1 unit if it's your first time buying. If you're buying 2 units, it would be a minimum 15% down. If you're buying 3 or 4 units, it's a minimum 25% down. So big thing to remember with conventional versus FHA, if you're going to live in the house, is if you're going multifamily, FHA is going to be your best bet for down payment options. If you are going single family, FHA is going to be your more expensive loan. FHA is a little bit looser with their guidelines. So like we said before, they allow 54% debt to income ratio rather than 49. They allow lower down payments for multifamilies, right? So it's a little bit more expensive of an option. So it's going to be higher mortgage insurance. Mortgage insurance also lasts for the life of the loan. Conventional is going to be cheaper mortgage insurance. The interest rates are generally about the same, but they're going to require bigger down payments depending on what you're looking to do, unless it's just a single family that you're buying. So a lot of people in the investing world are looking to buy multifamilies for their first house, live in a unit, live for free, right? And then kind of build their portfolio from there. And that's where FHA is going to be your best bet, because they're going to allow you to put the 3.5% down, whether it's a 1 unit or a 4 unit. And they're going to give you the least amount of cash out of pocket. And as we all know in the investing game, cash is king. So you want to spend the least amount of money so you can buy another one later on down the road. So that's the residential side. Now, you also have the investment residential side, which is where you're buying just a straight up investment property, which is strictly conventional. FHA does not lend on investment properties. So that's going to be conventional only. And generally, you're going to want to put 25% down or more if you go that route. And the reason being is that for single family investment properties, conventional does allow you to put 15% down as a minimum. However, the interest rate is pretty atrocious. And then you also have to pay mortgage insurance for, I believe, half of the life of the loan. Now, interest rate, if you're in the investing world, really doesn't mean anything, right? The only thing that means anything is what your payment is and how much you're getting in rent. So the interest rate could be 10%, but if you're making your ROI, who really cares? So at the same time, there is a benefit to being able to put that 15% down if you are trying to conserve that liquidity. But the interest rates get a lot more competitive at 25% down, and then you also don't have the mortgage insurance. So if you're looking to go conventional and buy an investment property straight up, you're probably looking at the 25% range. If you go anything above 1 unit conventionally, you're going to be forced to put at least 25% down conventionally. So that is kind of your standard residential loans that are available, and that's your standard, full documentation, exactly what we were just talking about, debt to income ratios, housing expense ratios, looking at your pay stubs, looking at your W-2s, looking at your tax returns if you're self-employed to verify you can qualify. So that's your full doc, most paperwork, best terms types of loans. The other side is commercial, but before I get into that, is there any questions about the conventional or FHA types of loans that are available and the benefits of each? Can everybody still hear me?
Yep, we got you. Anybody have any questions for Ryan on that?
Okay.
Well,
All right, cool. So that's your, like I said, and by the way, you can have a maximum of 10 loans to qualify for those programs. So 9 loans plus your primary home. Once you get to 10 different loans or financed properties, they call it, then you no longer can qualify for conventional financing. So technically you can own a primary plus 9 investment properties and still just go conventional. The nice thing about conventional, before I move on as well, is that as you buy investment properties, you get worried about your debt to income ratio, right? Everybody gets worried about not qualifying because of debt to income, but you can use the rents from the properties you're owning towards your income. So you can use 75% of the gross rents from that property towards your income. So if let's say you got $1,000 in rent, you can use $750 towards your income to offset that payment. So if your payment's less than $750 a month on the house you're buying and your rent's $1,000, your debt to income ratio is actually getting better than it is getting worse, because you're actually going to have a net profit on that property. So, so just buying an investment property does not necessarily affect your debt to income ratio if the rents offset it properly. So good thing to kind of keep note of. The other side of the equation is going to be your commercial programs, right? And I break these down into 4 different programs. You have your 1 to 4 unit fix and flip, right? So you're buying a house, you want to rent it out, you want to sell it afterwards, or you want to rehab it and then sell it afterwards. So that's we're kind of in between hard money and local banks, right? We're not as expensive as hard money, not as cheap as local banks. We're also not as hard on your documentation as local banks, but not quite as quick to close as hard money. So we're kind of a happy medium there. But that's where you can finance generally up to 75 or 80% of the purchase price of the property and 100% of the construction costs. And then they'll cap you at a maximum of probably 70 or 75% of what's called ARV, which is after repair value. So whatever the value of the property is after construction. That is going to be your short-term financing type of loan. 12 to 18 months is generally the standard length of those loans. You pay interest only during that period, and that's when you're getting the construction done, and then you would sell it before the loan or to expire and pay off the loan and keep your profit. You can also do that same program and refinance afterwards and keep the property as a rental. So that's where you would do a 12 to 18 month loan, fix up the house to how you want it to be, do a cash out refinance afterwards, get as much money back as possible. It's kind of hard to get all your money back these days. You used to be able to do it, but with the values going up, it's getting a little bit tougher. But you take out back as much money as possible, convert it into a 30-year loan, and then, you know, you just rent it out afterwards. That would be that infamous BRRRR strategy. So that's your first kind of loan, just your standard fix and flip loan. Then we also have new construction. So that's the same thing as the fix and flip. So short-term financing, 12 to 18 month loan, but now you're buying a lot, you're building on it right away. So same exact thing, you know, generally maybe a little bit more money down. So they might only allow you to go to 70% of the after repair value rather than 75 like the fix and flip. But same terms, you know, you're paying interest only during construction. And these rates are going to be anywhere from 7 to 10.5%, depending on what's most important in these kinds of loans is your experience level. So how many flips have you done? How many rentals do you own? How many new constructions have you done? And that's going to be hold the heaviest weight. And the more you've done, the better the terms get on those kinds of loans. Because they're commercial, all these programs also have 2 points up front. And they're basically built on the house, right? So they're called asset-based lending. So all 4 of these programs that I'm going to go over, the fix and flip, the new construction so far, are based on the asset, not based on you, the owner, right? Whereas previously the conventional loans are based on you, the owner, and your ability to produce income, right? Your W-2s, your pay stubs. In the commercial world, it's all based on the house. How much is it worth now? How much money are you going to spend to fix it up? What's it worth after? And does that make sense? And if it does, pretty much anyone with a decent credit score and money in the bank to pay for the down payment and closing costs is going to qualify. So as long as the house qualifies, you're going to qualify generally for these programs. So those are the 2 construction programs. So that's your new construction, and then your fix and flip, more of a rehab program where you're buying a house that just needs to be rehabbed. On the rental side and more the long-term loan programs, this is where you have your 30-year fixed rate LLC loans, right? So you're buying in an LLC. It's going to be a straight rental. You're just renting it out afterwards. And that's your 30-year fixed rate loan. And they'll actually do that for 1 to 8 units. So you can go up to 8 units and still get 30 years fixed. A lot of banks will not give you 30-year fixed once you go 5+ units. You're going to be getting into more unique terms with that. So that's just a standard straight up loan, 30 years fixed. Here's your rate, 2 points again. There's a prepayment penalty on that for the first 3 or 5 years, depending on how you want to set it up. and then otherwise it's just a standard easy loan. The qualification for that is the same thing. So again, asset-based lending, it's going to be based on the rents though. So this would be more of a debt service coverage ratio scenario. So this is where you're basically taking your net operating income, dividing that into your rents, and the debt service coverage is going to be, as long as it's more than 1, which basically means as long as you're making at least $1 a month in net profit, you can qualify, but really over 1.15 is what they're looking for the best term. So if you're at 1 to 1.15 on your debt service coverage, you know, you might be capped at 60 or 65% loan to value, right? Whereas if you're at 1.15, they might give you 75 or 80. So on this program, the 30-year fixed rate, you're gonna have 2 different kinds. You have a purchase and a cash out refinance or rate term refinance. So on the purchase, they'll generally let you put a minimum of 20% down. The interest rates are anywhere from 4 to 6.5%, depending on the house and how well it cash flows. And then you put 20% down, plus closing costs, buy the house, and it's just a straight up 30-year fixed rate loan. If you're doing a cash out refinance, you're probably going to be capped at either 70 or 75% maximum cash out. Again, all of this is really risk-based pricing, so it's going to depend on the loan amount, what the house is worth, your credit score, your debt service coverage ratio, and that's going to really determine what they're willing to do. But if you ever have a house that you're interested in and you want to see a term sheet, they're pretty easy for us to pump out, so we can send you the details and get your term sheet so you can see exactly what it'll look like. But again, the benefit of these, no W-2s, no pay stubs, no tax returns. We're not looking at you at all as an individual for income. We're only looking at you as an individual for assets. So if it's going to cost you $100,000 to buy the house, do you have $100,000 in your bank account? Otherwise, it's all based on the house to qualify for the income portion. The fourth type of loans, you have your fix and flip, new construction, 30-year fixed rate, 1 to 8 unit purchase loan program. And then the fourth type of loan, this is like your big portfolio loan programs, right? So you're buying 8+ units, you're buying multiple properties and you want one loan for it. So this is called the portfolio program. This is very risk-based. So I can't even really quote you the terms that they'll give you because they're going to ask you to fill out an Excel spreadsheet with a rent roll for the properties or the property that you want to buy. And there's a lot of people that are a lot smarter than me that are going to tell you what kind of terms they're going to offer you. But generally, you're looking at more of your standard commercial type stuff. So 20, 25-year amortization, 5 to 10-year fixed with potentially a balloon at the end, you know, a five-year step down, you know, prepayment penalty, but same types of qualifications. So still based on the rental income of the portfolio itself versus the debt, not looking at your personal income at all. And then again, your ability to, for the assets for the purchase of the property. And you can do the same thing. You can do a cash out refinance on a portfolio. You can do a purchase of a portfolio. To me, I try to avoid these on multiple properties because if you ever want to sell a property, it's a lot harder to sell off a property that's a part of one big loan than if you have every property individually mortgaged. But sometimes it makes sense for people. What this program is really nice for is, let's say you want to buy a 20-unit apartment building, right? And that's where this program can really kick in and be a great program to use. The one thing I do want people to use caution with is we're not a commercial lender in the sense that we're going to lend on a, you know, huge apartment building with a ton of commercial space in it. So most of us will sometimes allow up to 25% commercial space in a property, but we are a residential lender. So it is basically for residential properties only with some exceptions on the commercial stuff. So those are your 4 commercial types of loans. And then you also have your FHA and conventional if you want to go more the standard route, which is generally where most people that are starting a portfolio will be. And then once you get to the point where you're big enough that you know, you're kind of in that 10+ loan range, you're gonna have to move over to that commercial area. And the commercial area can also be really good, you know, if maybe you're self-employed, your tax returns don't look very good, but you still want to invest. you know, that's where those LLC programs can really make sense as well. But that's kind of it. I think I hit all the aspects on the commercial side that we're able to do, as well as the FHA and conventional. Any questions that you guys have for any of those loan programs that I can help answer? Or?
Hey, Ryan,
Hey.
could you explain the difference? I know a lot of guys on here purchase real estate through an LLC or through a C Corp, whatever entity they have set up there. From your perspective as a lender, if you're going to buy something in your personal name and in an LLC, what kind of differences are there from a standpoint they should consider?
Yeah, well, if you're going to go LLC, FHA and conventional are out the window, so they're not even going to entertain that. So you basically have to go the commercial route. But on the commercial route, you know, that's pretty much the only difference. Now, as far as the liability side, that's more of a personal thing and something that people should probably talk with their attorney about, not me. But me personally, I bought most of my houses in my own name until I ran out of the conventional loans, and I just had a, you know, $3 million umbrella policy to cover myself in case someone sued me. But some people aren't willing to take that risk and just want to buy all their investment properties in LLCs. And, you know, that's more of, like I said, just a personal preference. But outside on the loan side, the only difference is if you want to buy an LLC, you can't do the conventional and FHA stuff. You have to go that commercial route.
Awesome. Sorry, George, I didn't mean to interrupt you there.
Hey, no worries. I just wanted to get your perspective, Ryan, on a portfolio type of product versus what you do, kind of the positives and negatives, and what you've kind of seen in your experience. Thanks.
Yeah, I mean, if you have multiple properties, the only negative to a portfolio loan is that it's one loan on multiple properties. So if you want to sell a property or do something with it, you have to go to the bank for approval. You can't just say, hey, I'm going to sell my loan and list it tomorrow, because they need to release a portion of that lien, you know, based on what you're paying off. So that's really the only negative. Outside of that, the other negative is just that, you know, you're not going to get the 30-year fixed on a portfolio above 8 units. So generally, your payment's probably going to be more on a monthly basis, right? So if you're strictly looking at cash flow, it might not be great if you're in a full principal and interest loan. Now, sometimes on the commercial loans, they will offer interest-only terms, which in that case, it could be super beneficial to do the portfolio product because, you know, you could really bump up your cash flow if you're just paying interest only. Now, you got to know what you're doing at the end because you're not going to be paying any principal down. And if your tight, you know, values drop or something, you know, that could be an issue later if you need to refinance at the end of that 5 or 10-year balloon payment. But ultimately, if you're like, Ryan, I'm selling all these houses within the next 5 to 10 years, no matter what, get me a 10-year interest only option if I can, you know, you're going to juice your cash flows, create as much cash as you possibly can in those 10 years, and then just sell the house afterwards. As long as it's not worth less than what you owe on it, you know, you're good. I mean, personally, I don't see values coming down ever. I mean, they're not making any more real estate and they're making more people every day. So I can't see a situation where that happens, but you know, obviously values can fluctuate. So that's the only negative to the interest only option. But you know, there's a lot of pros and cons to every kind of loan, and it's hard to say exactly which one's best for somebody until you hear what they're trying to do and what their plans are, not only today, but also 5-10 years down the road with the property.
Yeah, I like that perspective because I know that a lot of the time they'll have a prepayment penalty or something baked into that. So I guess it just depends. So thanks for the clarification.
Yeah, absolutely. And most of those commercial loans, if you get in the commercial side, are going to have some sort of prepayment penalty. So generally 3 to 5 years.
Awesome. Thanks, Ryan. Is there anything else you wanted to talk about or any other questions we have from anybody on the call?
For myself, that was pretty much all I wanted to go over with everyone. You know, ultimately, just use me as a resource. I own rentals. I've built new construction. I've built fix and flip. I've, you know, bought, rehabbed, and rented. I've done everything. I also, you know, help first-time home buyers on a daily basis on the residential side. So I really know a lot about all facets of the mortgage world. So any questions you have, let me know. And I've also developed a really good team of people around me. So whether I can help you or not, I generally at least know someone that I can refer you to that can help out. So don't ever hesitate to give me a shout at any time, whether it's about, lines of credit, which we don't do, but I know a lot of banks that do. I know a lot of local banks in Pennsylvania specifically. So if you're looking in the Lehigh Valley or Philly, we can help out. And also, those conventional loans we can do all over the country. So whether it's Florida or Knoxville, Tennessee, or Austin, Texas is a big one these days. So, we can generally probably help you out in one way, shape, or form. So give us a shout and we'd be happy to help. And, don't hesitate to give us a shout. There's no dumb questions. So.
Awesome. Thanks, Ryan. I really appreciate you coming on here. I've had your website up in the background while you're talking, just so people have your mugshot and your phone number and email and stuff up there. But I'll send it all out in the follow-up and in the chat here. Everybody has it too. So I really appreciate you taking the time this morning to go over everything with everybody.
Yeah, absolutely. If you can, like I said, just copy me on the email you send out so I have everybody's info. It'd be great. And then any questions from anybody, like I said, don't hesitate to reach out ever. That's what we're here for.
Awesome. Thanks, dude. Appreciate it. Have a great day.
All right, guys. You too. I'm going to hop off here. So good talking with you guys and really appreciate the invite.
You got it. See ya.
All right. Bye-bye.
All right, Richard. I think you're next.
Okay, I'm up again. All right. So, that was a great presentation by Ryan. There's a couple of things that I'll probably capitalize on during this presentation, but and this will be relatively short. I was going to talk about clean and green, but I don't want to talk about that right now. I want to talk, this is a good segue into this, qualifying the lending, qualifying them and qualifying you. A couple of things, we just moved to Ohio, my wife and I. We purchased this property and got a pretty sweet deal on it. It does need some work and we're doing that now. So, but it does, one of the things that we actually did was we used some corporate funds for the down payment on the property in a conventional loan. So I thought I heard Ryan mention that he couldn't do that, right?
I believe you're correct.
Okay. Well, you can do that. Depends on the lender, of course. In my case, what I had to do, since I have a C corporation, is I had to do what's called a gift letter because the mortgage we decided to put in my wife's name because she has that residential, she meets all the residential requirements better than I do in terms of income. But when we did that, we used corporate funds. We had to do what the bank wanted was a gift letter, and it was only for the purposes of them doing the underwriting. It does not come back on my corporation, and I had to make sure of that. So I had my accountants involved, and I had my other people involved in the transaction, and to make sure that we were safe from a tax perspective. But they allowed us to do the transaction via wire transfer directly from the company, which is what I wanted. So it looked like the company was making that investment, which is what we wanted to do anyway. So it's just a little blurb on some things can be done. It all depends. And it's kind of like what we discovered earlier on, that in the case of DTI, that's a flexible number, depending on the circumstances, depending on, changes that maybe Fannie and Freddie might put out or an FHA. So, you're going to have some flexibility depending on the lender that you choose, which is a great way of coming into this conversation. So qualifying the lender, you know, when we talk about what is a lender, we immediately think of a bank. That's not necessarily the case. I'm going to talk a little bit about pre-qualification, pre-approval, residential mortgage. Everything that Ryan said earlier was pretty much spot on. I'm just going to add to some of that. Same thing with commercial loan qualifications. I remember I did a deal where I got a term sheet from a commercial lender, and that made local decisions, which is something else I'm going to talk about. Local decisions is important. The decision chain is really important to know from any lender that you would go to. And then some qualifying questions to ask a lender, things that you want to ask about, you know, the prepayment penalties and things like that are going to be a factor in terms of what you do with that loan. And then, of course, I'm going to talk about the relationships with an investor. So let me jump right into it. What is a lender? A lender basically is anyone with money to lend with an expectation of return. It's not just a bank. It's going to be, you know, the people that are in your life, people that you know, other investors perhaps. There's hard money. There's private money. There's lots of different ways to get that money. And as we go forward, and as I attend the John Burley seminar in Phoenix coming up in April, which speaks specifically to OPM, I'm going to come back and share some of that knowledge with you guys. So look for that in the coming months. But I'd say look local first. Your current investment equity. What do you own already that you have some equity in that you could extract some funds from? That's usually the best way to go. And then secondly to that, it's going to be your personal investments and savings, what you got in the bank in terms of liquid. And then, of course, if you have to go to family and friends, I tend to really not recommend that avenue, because you know you got relationships involved and you don't want to borrow from family, because you know you could have some issues in terms of what that looks like. But in either way, you want to always have some type of documentation in place whenever you are exchanging large sums of cash for the purposes of investment. Okay, so look local, look at what you have available to you first, and then you go to the banks or the credit unions. You know, big is not necessarily better, by the way, with the banks. You think of Bank of America, Wells Fargo, Citibank, those guys, it's not necessarily better to go with them. And there's more than likely to be a lot more in the way of due diligence and things that you're going to have to do with them than you may not have to do with someone like was it My City Mortgage? Is that Ryan's company? Yeah.
Yep, My City. It's his brokerage.
Yeah, that's his brokerage. So you know, but you want someone that can give you local decision authority. Local decision authority is important, because when I got my term sheet on a commercial property that I had was looking to do, the decision was made locally by the guy I was talking to on the phone. It wasn't a committee. It wasn't someone down, or you know, a chain of people in New York or someplace else that really had no vested interest in my success. It was a local guy. And then there's, of course, you got private money. Private money is the next best option, and maybe even slightly better than a bank, because private money is someone that has a lot of money and they want to invest it, and you know, they're looking for that relationship where they can make money and get a better return than they would if they were, you know, if it was at a bank. Hard money, of course, we know what hard money is about, right? Flips, relatively fast, high interest rates, fees, and heavy penalties if you don't deliver. So hard money is useful, should not be discarded as an option, but just understand the risks involved with that. And then, you know, mortgage brokers versus direct. You know, Ryan's a mortgage broker. That means he can shop the financing to several different places. That's a good thing. But you also have, he's also a middleman. Now he's got to eat too. So just understanding that a mortgage broker is not a bank, and you know, there's going to be a delay in translation between the requirements between where the money is and where you are. versus direct, and you're going to a bank directly then in that case. All right. So let's talk a little bit about what pre-qualification is about. Pre-qualification is just that letter that you get when you go and you request, you know, hey, I want to get pre-qualified because I want to go look at this house, maybe make an offer on it. It's just basically a letter stating that you're credit qualified or capable of getting a loan. It's not anything that's really intense. It just simply says that, hey, you know what? Based on your credit score and the qualifying ratios that we talked about earlier, you know what? We could probably get you a loan. Okay. So how much you can actually buy is not, and it never is, the same as your pre-approval letter for the most part. Okay. So your pre-approval letter, I'll give you an example. You know, in my wife's case, she got pre-approved for $300,000. Could she afford $300,000? Really? Could we afford that? Even, you know, both of us? Yeah, we probably could, but just based on her pre-qualification, there was no way she could spend $300,000 on a property. Okay. So your pre-approval letter is just basically the bank telling you that you can't get a loan, and it's a good thing to have, and it starts the process of you being able to go down that path of the purchase. And it can be obtained either the same day or a couple of days later. It usually doesn't take long to get it, and but it does not. Just understand, it does not take into account any of the intrinsic analysis of your overall debt situation. It's just not that way. Okay, so you want to make sure that you're that when you get that pre-qualification, you don't be like, oh, goody goody, I pre-qualified for $500,000 from Wells Fargo. Well, okay, that's nice. Now you go out and try and buy a $500,000 property on a, you know, $50,000 salary and see what happens, right? Any questions so far? Any thoughts, comments? Okay, so let's talk about residential mortgages real quick. The qualification process for residential mortgages, I'm not going to spend a lot of time here because I think Ryan did a great job of talking about that. But you know, in order for you to get that money, there has to be some financial equity between you and the bank. So let me give you an example. If you are going out and you're trying to buy a property that's, say, worth less than $50,000, you're likely not going to get a loan against that property, because by the time you put the down payment money into it and the closing costs and everything, the numbers work out, the bank is not going to have enough of a note to make it worth their time to underwrite a loan of such a small amount. Okay, so in some cases you got to go, you know, the bigger the loan, the better. So 100 grand. In fact, I think that a couple years ago I was looking at a number of properties. They were depressed, but they were all on the same street. So I was thinking about what was mentioned earlier about portfolio loan. I thought about, well, maybe I just buy them individual that can just pay cash. But then I got to renovate them. But no, I need a bridge loan for that. And, you know, I looked at all of the different options that I had and decided against it. But I went to the bank and I asked them. I had one property that was right at about $55,000, and there were a few banks that wouldn't underwrite a loan on just that one property because it was too small. Okay, they would tell me that their minimum loan amount that they would underwrite was maybe 50 grand after, you know, the down payment was already made. So in other words, 70 grand, say if you take, or 60 grand if you take 20%, right? But those are things that's you're gonna want to consider. And if you go to a mortgage broker where he's going to shop that financing, you're likely going to find, you know, a number of different options in terms of how you can underwrite that loan. Now, I will say that if you're going to do a portfolio loan, just understand that's for the long term. As Ryan mentioned, if you have to pull one property out of that portfolio, you're going to have to basically refinance the other properties in order to get that. So you're going to have basically two closings. Where you're going to have one for the peeling that property out, the one property you're wanting to sell, and then also for refinancing the others. Okay, so a higher administrative cost to pull a property out of a portfolio. So anyway, other things in terms of mortgage qualification are going to be Dodd-Frank. You know, in 2008, you know, they had to, you know, we had that crash and the predatory lending practices that were going on at the time. Dodd-Frank was supposed to satisfy that, but Dodd-Frank did do that, but it also created other problems. And so just be aware that you're going to run into that as well. And in terms of a residential mortgage, look, it's all about you, your credit capacity, your capital, and your collateral, okay? Your credit is going to be an important factor to that. Your money personally that you have in the bank, your debt, and your W-2 income, that speaks to the durability of your income, which is going to be an important consideration. And then the value of the property in terms of the appraisal has to come in at a value that's worth it. So, and then of course I talked about DTI earlier, and then you can see that some of these numbers are flexible, but for a conventional loan, you're going to be putting 20% down. If it's a commercial loan, it'll be 25. If FHA, 3.5, VA, you don't have to put anything down. So these are some of the things that you want to consider or think about as you consider your mortgage qualifications for residential mortgages only. And then again, DTI, we ran into that problem with DTI ourselves when we were buying property, and we ran out of debt to income, and even though we were making money. So just understand the residential mortgage process. There's some pretty well-defined parameters behind what happens and how you go about getting the capital you need to close on that loan. With commercial, it's completely different. And you're going to find that in commercial loans, that qualifications it's mostly revenue based, as Ryan mentioned earlier, right? It's about how much that property is making. There are some type of business considerations that will be made depending on the institution, but it's not about you in as much as it's about the business itself. Now, where it does become about you to some extent is in terms of your company. If you manage a corporation, an LLC that you use for the purposes of investing in real estate, they're going to be looking at your profitability. They don't want to look at your tax returns to make sure that you know what you're doing or that you're at least making money, okay? And it's more about the quality of the deal. Now, the debt coverage ratio that I was given by at least two other banks, one of them was First National Bank, when I did, this was last year, when I was looking at some commercial opportunities. They told me they say, if you got a debt coverage ratio of 1.2 or better, you're pretty much set on getting that loan, okay? So, Ryan mentioned 1.5. Yeah, that's okay, but 1.2 or better, and you're pretty much guaranteed to get that loan, provided all the other factors are in place, okay? You're gonna have a higher down payment, and you're gonna have a higher interest rate. Typically, the term sheet that I had received was for, this was for and Matt, you may remember this, it was for that $1.2 million property, right? The term sheet was for 5 years fixed, and then it was variable. The rate would change, so it was a mix of fixed and variable rates every 5 years in my case. Now that's flexible. That could be anything, whatever the lender decides. The term was 25 years. That was my max term. You're not going to get a 30-year commercial loan. You're going to get a 25-year commercial loan, and it's going to have a rate adjustment every 5 to 7 years, okay? There was prepayment penalties, but only within the first 5 years in my case. Not saying that couldn't extend beyond that, it certainly could. So you got to look at those parameters and make sure that you know what you're looking at before you make a decision to commit, okay? Any questions on that?
This is good, Rich, thanks.
All right, so qualifying the lender. All right, so we know all lenders aren't created equal, okay? We tend to think that because the process we go through is the same for most all of them, where you've got to pull your credit, and you got to look at your debt, and they're going to ask you questions, they look at your tax returns, and you provide all the same information. But they all use that information just a little bit differently. So you want to shop at least 3 before you decide on a lender, And you want to make sure that you have a lender that really, really listens to what you say. We had some hiccups when we were trying to buy the place that we're in, for example, you know, where we told them up front that we're going to use this is going to be part corporate, part residential type transaction for us, because we're using some corporate funds for the down payment. And we ran into some issues along the way. And I reminded the lender of, you know, what we told him already, and always document what you do. If you say something to a lender, send them an email to follow up, say, as we discussed, you know, just want to make sure that you knew this and that you had this information so they don't forget. Okay. So that way, if they do bring it up, say, hey, you didn't tell me. Oh, yeah, I did. Look at the email dated such and such. Oh, yeah. Oh, gee, I'm sorry. Well, now, never lose the advantage. Never give up the initiative, right? And then use that to your advantage when you need to. Okay. So what are the loan products available? You know, loan products, this is something that, you know, you say you go to get a loan and you're thinking, well, it's just a loan. No, there's different loan products. And every institution has a bunch of different products, as they call them, loan products that they use for the purposes of lending to individuals or companies, or LLCs in this case, right? And so those loan products can be anything from conventional loan products that have some particular incentives. It could be FHA loan products that have other incentives. And by the way, those incentives from they're handed down, I think, and Matt, you keep me honest on this, I think, you know, Fannie and Freddie are always changing stuff. So they send stuff down the pipeline all the time to these lenders, and these lenders incorporate those things into their loan products. Same thing with FHA, okay? You never know about it as the consumer, but the bank knows about it. And so you want to ask those questions. What are your loan products? Can you send me a list of the loan products that you would, you know, suggest for my type of transaction? Maybe just send me all of what you got, because it's usually can fit on a single sheet of paper, okay? And look at what they have. Like in the case of if you're buying something that's in a rural community, you might want to look at USDA. You may want to look at that instead of a conventional or FHA. You may want to, again, conserve that cash, okay? Ask about the chain of authority, local decision versus committee. I can't emphasize enough how important the local decision makes a difference in terms of the quality of lender you're dealing with. Because then if it goes to a committee, that, you know, if it's not a local decision, the person you're talking to, that mortgage broker, or not mortgage broker, but that mortgage VP at the bank, or that person that you're talking to on the phone is telling you, and yes, 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 but then by the time it gets to underwriting, which is in New York or LA or Chicago, it's no, because of something that they needed. Well, that can be frustrating. That's going to be a point of frustration for you. And that's where you find these deals that go so far and then they fall through the floor, because, you know, the decision authority is not the person that we're talking to. It's some committee or some underwriting group of the bank that's further up the food chain, okay? And then you want to ask a question about what are the fees. Again, every institution is going to have different fees. Some fees are standard, like title fees and things like that for the title company and stuff, but other fees are not. And you can, in fact, negotiate some of those fees. Ask about the discount points. You know, in some, I have seen instances where some include or assume discount points when they make an offering of lending that seems like a better deal, okay? So you want to be careful of that and look out for that. If you get a pre-approval letter and they say, well, it's, you know, it's 2% and, you know, 500 grand, you're like, wow, how can you offer me something like that? Well, it's with, you know, 5 discount points that you got to pay for. Okay, so you want to look out for that. And then, of course, the interest rate versus the APR, you know, they're not the same. The APR is what you pay annually, right? Versus the interest rate that you pay. In our case, we got a 3% loan and our APR is 3.25. Okay, so, and then you want to also ask about rate lock validity, because you want to ask for that rate lock. They may quote you a rate, but you want to ask them or make sure that they lock that rate in for the period of time that you are searching. So,
Hey, Rich,
yeah,
that is especially important now during inflation and as the rates are creeping up every week. The Fed,
absolutely.
they can raise it up to a quarter point at a time, and up to 7 times a year is what the most recent publication is. So if you do a quarter point times 7 times in a year, you can have interest rates start going up very, very quickly. So rate lock is super critical, but it's only valid on the calendar for so many days. And you might have to pay to keep that rate lock in the future.
Yeah. Yeah, it's a very good point. Very good point. You know, so make sure that you ask for that rate lock. They may quote you the rate, but you want your next question is okay, how long can we lock that in for? And they'll say, well, we can lock it in for 30 days, sure. And it should be free, but it may not be free in the future, especially with the way, as Matt says, the inflation is right now. And then, of course, prepayment penalties, you want to ask those questions too. Generally speaking, on a residential mortgage, there is no prepayment penalties. That usually happens only on commercial, but don't forego asking the question. Are there any prepayment penalties? If you underwrite this loan and I pay off the house in 3 years because I was a stellar investor and I made all kinds of money, I was clipping coupons the whole time, are you going to charge me a prepayment penalty because I paid it off in 3 years? You know, so ask the question is what you want to do. All right. And then, of course, next to my last slide here, relationships as an investor. Look, you know what? Look, just get good with a good mortgage broker or banking institution. Ryan's a great guy. Very smart, very disciplined, and has a lot of experience under his belt. He won't steer you wrong. But, you know, as much as I love Ryan, I would say always double check with others to make sure that the information lines up. Okay. Trust nobody with your money. Okay. But get with a good mortgage broker or banking institution, preferably a local one. And a local bank is the way to go, or a local mortgage broker is the way to go, someone that focuses regionally. Big banks ain't going to bother with you unless you're a qualified investor. Okay, a qualified investor, most of you may already know, is one that meets certain qualifications in terms to be called a qualified investor. You got $1 million in liquid. You got, you know, some other factors behind you that makes you interesting, okay, to a larger institution. Work with those that make local decisions. Again, smaller banks, the process is pretty much the same, but the underwriting authority may have better flexibility. You know, if the decision ever came down to the relationship between you and another person, you better win. Okay. So if you're dealing with the decision maker in any given situation, you win. That's the attitude you need to have. Bring well-qualified deals to these folks. Don't just, you know, throw enough stuff against the wall and hope some of it sticks. That's not how we invest. We want to bring well-qualified deals we research, we do our deal check, we make sure everything that's done. And Matt's going to talk about some of the tools that him and I use in order to qualify deals. And when we go to the bank, we've already done our due diligence. In fact, we've done more than any institution would ever expect. And that's the way we want to get you guys to. And then set up an entity to do more commercial or portfolio type deals. Residential has an effective cap based on DTI. Remember that, right? So you want to set up an entity. Now, one of the things I was thinking about doing, and we've been discussing this, and it's a little premature me bringing this up now, but I'm gonna say it anyway. And that is, you know, setting up an LLC for each investment property that you buy. Set up separate everything, LLC, bank account, all that. Try not to do a single member LLC for these. Make them multi-member LLC so that they can be more of a legitimate business and not just pass through to you as an owner, which is going to happen anyway from a tax perspective. But it will be easier to spread that risk across multiple members in an LLC versus it just being you. Okay. But that's something that we've been toying around with. We haven't decided which way we're going to go with it, whether we put it all under one LLC in a given region, or if we do do an LLC for each house. It takes no time to set up these entities if you know what you're doing. And then, you know, it does give you at least some level of protection. Your insurance is going to be in the name of that LLC for that investment property so that you'll be protected. So you'll want to make sure that you figure that out for yourselves. Me and Matt have some great ideas. Talk to either one of us. We can kind of give you some information to help you along that way. But definitely talk to your financial advisor if you have one, because he will know or she will know exactly what to do in that situation. Again, network with alternative financing and bring salient opportunities. You know what? We're all about meeting people and talking to people that have money. So, as we meet them, nurture those relationships, keep it simple, build the trust, and just be your word. And, they might feel comfortable enough with you to do a deal with you someday. Okay. We don't have to be smarter than the rest. Just have to be more disciplined. Smart. That's all I got for you. Matt? You're muted. Hey, Matt. Uh-oh. Did I lose Matt?
Oh, can you hear me?
Oh, there you go. Okay.
Sorry about that, man.
No problem, man. Did you get all of that?
I did at the very end. That was awesome.
Okay.
Thank you so much for putting that together.
We'll do clean and green. I'll send that deck out. It's not a lot to it, but we'll send that deck out as part of the thing, because we're running out of time and I don't want to do that right now. Okay.
All right. Yeah, that sounds good. I'm going to jump into my side really quick. All right. So can you see this screen?
Yes.
All right, cool. Just a few of the tech tools that we use to self-manage. If you're going to manage your own property, obviously you can save a lot on cash flow by not hiring a property manager, but some people's business revolve around not being a part of the mix. So these are just some of the tech tools that we use to manage our business as far as communication, application, and then when it comes to evaluating deals, there's all these different things you can go to. So I'm just going to go through briefly what we use, not get into any details, but in the end, it all comes down to what you're comfortable with. So for us, being a formal entity, to have the real estate in to separate from personal assets was very important. So everything's LLC. I know that there's difference of opinion in different situations. So everything for us is LLC. We determined that we didn't want to have any of our personal address information, contact information out there, which is a good way to separate your church and state, essentially. So we have everything in the company's name. We have a PO box. There's no formal address associated with our personal account other than at the state. We have a Google Voice number to be able to filter all of our information into and out of. So every business call, including lenders, contacts, formal records at the municipalities, utilities, are all through a number that is not yours. I highly suggest, if you're going to do this as any sort of business or side business, to have a contact information that is not your personal, because when things go south, it's just a matter of separating all of your personal life contacts from your business life. So Google Voice is the first one we're going to jump into. This is a pretty sweet application. I know some of the guys on the meetup that aren't on the call today use this. It's a really cool application. It's on your computer, could be on Mac, PC. It has apps on an iPhone, Android, iPad, all the tablets. So you can run your full business through a virtual number sponsored through Google. And it has all of these different functions. You could make calls through it. You can send text messages through everyone here. You have voicemail capability, text through the voicemail. You have the ability to archive and download calls. You could set up voicemail. There's really, really cool functions from all these different aspects, but mainly you can have it up on your desktop, your phone, and it'll ring just like a regular phone call. You don't need to have a second phone, drag around all that stuff. And if you have a team of people, the people can answer the phone on your behalf. So again, I don't answer this phone all the time. Either my wife or someone else is able to take care of the calls when I'm busy flying or otherwise committed. So it's a really good tool to help keep your business as business and out of your personal name and your personal life. However, at some point they're going to cross, and you want to make sure that you're as protected as possible. So Google Voice, I highly suggest this. We've been using it for quite a few years now. You get a number, you use the number, and you have this account. You can log in through all of your Google apps here. You can do everything all from the same source. The next thing we use, apartments.com, is what used to be Cozy. We have the ability to collect rent virtually and without any sort of, oh man, it's going to make me do this. I apologize. Hang on. No checks, no cash. And it is a very, very easy way to collect without having a problem of an excuse from the tenant end. Oh, I don't have the money. Okay, fine. It automatically charges you a late fee. They have to connect their bank account. They have to do everything right from the beginning. And it's one less thing you have to worry about. You don't want to show up at the house, knock on a door, and get rent. 274. I don't know why this is doing this. So this is just for one of our properties, the one in town here. It's a pretty cool setup. You go in through here, you have your different rents due on certain days. It automatically pulls information from their bank account. At no point do I go in and I ask for a rent check. It automatically is withdrawn. It comes through all of these different features the tenants can set. Like these guys have their rent payment split between two of them because they're not married couple, or all these others. They are pulled automatically from the bank account, deposited in our bank account about 6 to 7 business days later. We're okay with a delay because it's free, completely automated. And the cool thing is you go into any particular account and it has a running sheet of their payments when it's completed. If there are late fees, thankfully there's not, because they get automatically billed. But apartments.com is fantastic. It is absolutely free to a landlord. The way that they make their money is through rental applications, which I don't use their service, but it is a way for you to have another layer of official business when you're dealing with tenants. You don't want to be the guy who's nailing on their door for rent. You don't have to be if it's already automated. And when it comes time for the end of the year, they automatically send you your tax paperwork, how much rent you received, because they're the middleman to receive it. And it's just a really, really good tool that we use. So between these two, Google Voice, apartments.com, and through our website here, if we go in through here, we go to housing solutions, and you have any of these forms that you can use to contact a landlord. There's also a way they can apply through our website. The combination of these three services is very, very easy to self-manage. So if you're just starting off, or you have guys that are self-managing, I highly suggest this. Otherwise, you go to a property management company, but that's a different conversation for a different time, using a property management company. Lastly, the one that I want to share and go through most with is this website called DealCheck. DealCheck is a fantastic resource that allows you to single-handedly import properties, analyze cash flow, analyze purchase price, and then work backwards to a maximum allowable offer, or you can customize your criteria. So this is one that we're looking at right now down the street. It has a whole bunch of different units. There's ways for you to go in here and edit the property, use financing. What kind of financing do you want to obtain the property through? What kind of purchase costs or closing costs you have, and what kind of rental income you expect. And the way you'd evaluate a property before you'd even go to a lender, like Richard was talking about, you'd evaluate the property through either something like this, or it's, let's see here. or something like this. Everyone's familiar with a Excel spreadsheet. We have versions of this. If you'd like a copy of this or one that might apply to your particular scenario, let me know. I know Richard and I as agents, I'm sure John, the same thing out west. If you're working with an investor, you want to make sure that that investor is completely in tune with what this property is going to require financially, what it's going to return as an investment. But we get pretty far into it. You want to know your capital expense schedule, your utilities, how much each of those are going to cost, and then a mortgage amortization over time. This is a good way to see what type of payments you're going to have in the future, early payments if you choose to do so, payoff dates, 25, 30 years in the future is a long way away. However, it's good to have all this. Every month you check away at it. All of us should be looking at, your personal balance sheet and your business balance sheet on a monthly basis at least, because when the bank is going to go and talk to you about your next application, they're going to want to know what your assets are. Even if it's not a commercial, they're still going to want to know your cash, your liquid assets, your real estate assets, and what kind of liabilities you have. So this website, DealCheck, is a way for you to go in and single-handedly on one source, import property data from public records for listing if it is an active listing. And you can completely customize it to the point where it pumps out these really sweet reports that you can brand. And it looks extremely official that you can now print this out and bring to the bank and say, hey, Mr. Lenderman, here's the report that I did. Here's the address, here's the rent rolls, here's everything about it. It gives a nice presentation. It goes down through purchase price, return on equity. So this deal right off the bat, I knew this is not going to be a good deal at its purchase price. The property has a lot of room for appreciation through rent increases and forced appreciation or adding units. So there is a potential for this to be a good deal, and it is across the street from another one of the multi-units that we have. But if you take this on a deal that is a great deal to a lender, they are going to be so completely impressed, and Richard can attest to this. It is more thorough than anyone could ever imagine doing. You want to be able to analyze a deal and know within 30 seconds if the purchase price and then your investment return is going to be worth your time and your money. And this program makes it very, very easy. It breaks down cash flows over the future, over years, cash flows over time.
Yeah, by the way, you also set the criteria of this, the parameters, like what do you want the ROI to be, the cap rate, what the thresholds are. You get to set all of that. And Matt, if you want, I sent I think when I turned you onto this I sent you my link to the DealCheck and where you can get a discount.
Mm-hmm.
I don't know if you still have that, but I get a little bit of a commission off of it too. But if you send that link to the group, then they can decide if they want to they want to go for it or not. But yeah, it's awesome, guys, and every lender is impressed with it because it's all you.
What it does is, Richard, that link you have actually gives them a discount to use the program. It's not cheap. I think it was $100 or $200 a year for the service, which, one deal that you make a lot of money on, it immediately pays for itself. So this is a tool in your toolbox to be able to evaluate deals. It's an investment in your business. And I think, Richard, if you send me that link, I'll include it in the link out to everybody. So they get a discount if they sign up, and then you get a cheaper monthly rate on yours. So it's not like a huge incentive to refer people, but if you're going to be analyzing a lot of deals, this program is fantastic. It does a lot of great things. And here's the criteria for this deal, particularly. It's not a good deal. The price per square foot is too high. It fails the 1% rent rule. Cash flow is less than 400 or 100 per unit. So as it sits, this is not a good deal. But what I can do is I can go back. Can you see this page that I switched back to?
Yes, we can see that.
If I go back to the rental and I go to market rents, now all of a sudden this property performs. Buy it at the right price. Some of the units are month to month. Now all of a sudden your operating income's up over $1,500 a month from where it was, and this thing's cash flowing almost $1,000 total. However, it still doesn't hit all of the points, because for me, I like the purchase price to be in a certain amount per square foot. However, there is an intrinsic value to this property because it is across the street from another one we have. So if it hits most of the criteria and not all, you can make your own decision if it's a good investment or not. But this is only based on if the seller is wanting to negotiate at a certain price and certain criteria. So DealCheck is a fantastic resource that we use, and it doesn't just do rentals. It does BRRRRs. Like for this is the one that we were looking at before, way back here. This is one that Brian actually brought to us before. Interesting situation. You throw this in, you buy it in cash, you refinance it, or you rehab it. You put all your rehab prices in here. This is a very expensive rehab here, almost $70,000 based on a massive foundation problem. And then you can go back and see based on what its repair value would be after the repairs, or after repair value, if it's really worth the investment. So it does rentals, BRRRRs, it does flips here. You could do all of these different flip calculations based on holding periods, how long. If you notice here, a flip now is not a quick process. You buy a house, you're going to be in this thing for at least 3 months before any repairs are done. And then before a bank is going to even finance it for the end buyer, that's 6 months. So your holding costs, unless you can rent this thing out in the meantime, your holding costs need to be really in the future, because you don't want to be stuck holding this thing for longer than you have to. Flips are a pretty volatile market right now. You don't want to be caught with your pants down, especially as interest rates start to go up. So make sure it's a pretty good deal before you do it. So this DealCheck website, I keep going back to it. It's good for wholesalers. We don't do anything with wholesale for the most part, but for the other types of investments, this is a extremely valuable product. So do you guys have any questions on that or anything that we discussed? I know we're getting up to 1 o'clock here. No. All right, cool. I appreciate everybody coming on. Richard, thanks again for all your information there. And I'm glad Ryan was able to call in and give a little bit of info. Thought we'd have a little bit more people on the call today than we did. But again, this is going to be in the YouTube channel. We're going to have it up on the REI Partners Facebook page. And Richard, do you want to talk about the website really quick?
Yeah, the website will be up this weekend. Matt and I are going to work on it, but we'll have something up this weekend. And we decided that we're going to make it to where you will be able to create an account and eventually be able to manage the information that we provide to you. Download, special, things like spreadsheets or things that you otherwise wouldn't want to put together yourself. So anyway, we're going to get at least a template up this weekend, and then we're going to work on enhancing it over the coming weeks. And we'll send out an announcement on the Facebook page.
Awesome. Thank you, everybody. It'll be out shortly. I'll include Ryan's information and Richard's contact if you have any questions about this. And again, we look forward to everything in the future. So thanks for calling in, guys.